Wrapped Bitcoin has grown to over $10 billion in total supply, making it one of the largest token ecosystems on Ethereum and one of the most significant financial infrastructure innovations in decentralized finance. By representing Bitcoin as an ERC20 token on Ethereum, WBTC enables Bitcoin holders to access Ethereum's DeFi ecosystem without selling their Bitcoin exposure, unlocking lending yields, liquidity provision opportunities, and DeFi composability that are unavailable on the Bitcoin base layer. For institutional investors holding Bitcoin as a strategic asset, WBTC and its alternatives represent a yield enhancement opportunity. Bitcoin exposure that generates 2 to 5% annual yield through DeFi lending protocols rather than sitting idle in cold storage. The yield is generated from genuine DeFi lending demand, not from protocol token inflation, creating a fundamentally different risk profile than DeFi yield farming strategies. This analysis provides the institutional framework for evaluating WBTC and alternative tokenized Bitcoin solutions, understanding the custody and smart contract risks that differentiate institutional-grade options, and assessing whether DeFi yield generation on Bitcoin exposure is appropriate for specific institutional mandates and risk tolerances. The WBTC mint and burn process is fundamentally a custodial bridging mechanism. Bitcoin is held by a regulated custodian while a token representing that Bitcoin circulates on Ethereum. The mechanism is simpler and more transparent than most cross-chain bridge designs, which is a security advantage. The WBTC smart contracts are relatively straightforward compared to complex bridge architectures that have suffered the largest DeFi exploits. The custodial structure creates a specific counterparty risk profile. WBTC holders are exposed to BitGo as the custodian. If BitGo were to suffer a security breach, regulatory seizure, or insolvency, WBTC holders could face difficulty redeeming the underlying Bitcoin. This is a qualitatively different risk than holding Bitcoin directly in self-custody but is comparable to the risk of holding Bitcoin with a regulated custodian, which most institutions already accept. The merchant system creates an additional counterparty layer. Institutions must work with WBTC-approved merchants to mint and redeem tokens. The merchant list has changed over time. The original Alameda Research merchant relationship was obviously complicated by the FTX collapse. Current merchant options include Coinbase, which provides institutional-grade counterparty quality for the mint and redemption process. The tokenized Bitcoin landscape has expanded beyond WBTC to include multiple institutional-grade alternatives with different custodial structures and risk profiles. Coinbase launched CBBTC in 2024 as a direct competitor to WBTC, backed by Coinbase Prime custody rather than BitGo. For institutions that already use Coinbase Prime for custody and trading, CBBTC provides a seamless tokenized Bitcoin solution within an existing institutional relationship. The custodial model comparison is not simply about which custodian is higher quality but about which custodial relationship is already established in the institution's counterparty framework. An institution with an existing BitGo relationship for multi-SIG custody has a straightforward path to WBTC deployment. An institution with Coinbase Prime as its primary custodian benefits from the simplified operational model of CBBTC within an existing relationship. Decentralized alternatives like TBTC, maintained by the Threshold network, offer a trust-minimized option that does not rely on a single custodian. TBTC uses a distributed network of stakers to hold Bitcoin backing, eliminating single custodian concentration risk at the cost of more complex smart contract exposure and lower liquidity than WBTC. For institutions where decentralization and custody risk reduction are priorities, TBTC represents the most institutionally sophisticated option despite its lower liquidity. The DeFi yield available on tokenized Bitcoin positions represents a meaningful yield enhancement for institutions that already hold Bitcoin as a strategic asset. Supply yields of 1.5 to 2.5% on lending protocols like Aave and Compound are generated from borrowing demand, primarily from traders who want to borrow WBTC to establish short positions or use WBTC as collateral for stablecoin loans. The liquidity provision yields on Curve Finance BTC pools are higher, typically 3 to 5%, but involve additional complexity and impermanent loss risk relative to simple lending supply. Curve BTC pools typically pair WBTC with RenBTC or CBBTC, and liquidity providers earn transaction fees from trading activity between the tokenized Bitcoin variants. This is a relatively low impermanent loss strategy since the assets are all Bitcoin pegged and their prices track closely. The yield comparison against the risk-free rate is crucial for institutional evaluation. During periods of elevated federal funds rates, as in 2023 and 2024, DeFi Bitcoin yields of 2 to 4% are not obviously superior to risk-free yields of 5% on a risk-adjusted basis. The DeFi premium must compensate for smart contract risk, custodial risk of WBTC, and liquidity risk. For institutions with Bitcoin positions that would otherwise be in cold storage earning zero yield, any positive DeFi yield represents an improvement, but the risk-adjusted comparison to tokenized treasury alternatives deserves explicit analysis. The WBTC risk framework has become more complex following BitGo's 2024 governance discussions that raise questions about the custodial structure of WBTC backing. These developments highlighted a risk that had not been prominent in earlier WBTC analysis: governance risk in the custodial relationship. WBTC's value proposition depends entirely on the quality and independence of its custodial governance, and any changes to that governance structure deserve immediate institutional attention and re-evaluation. The DeFi protocol stacking risk is particularly important for institutional allocators who tend to evaluate WBTC and DeFi protocol risk separately. A WBTC position deployed in Aave involves at minimum 3 distinct risk layers: Bitcoin price risk, WBTC custodial and contract risk, and Aave smart contract risk. Evaluating only the DeFi protocol risk while assuming WBTC is risk-free produces a systematically incomplete risk assessment. For institutions concerned about WBTC governance developments, CBBTC or TBTC provide alternative tokenized Bitcoin exposures with different risk profiles. CBBTC's risk is concentrated in the Coinbase counterparty relationship, without the WBTC governance complexity. TBTC's risk is distributed across the threshold network staker set with no single custodial counterparty. The appropriate choice depends on each institution's specific counterparty preferences and existing custody relationships. The tiered institutional approach to tokenized Bitcoin yield allows institutions to match their DeFi risk tolerance with appropriate yield strategies. The conservative lending-only approach is the most straightforward institutional entry point. Deploy WBTC or CBBTC into a single, audited, large-scale lending protocol and earn a modest yield enhancement on Bitcoin exposure that would otherwise earn zero. The moderate curve liquidity provision approach offers higher yield with a risk profile that is qualitatively different from lending. Rather than earning interest from borrowers, liquidity providers earn transaction fees from traders who swap between different tokenized Bitcoin variants. The impermanent loss risk is lower than typical DeFi pools because all assets in the BTC stable pool are pegged to Bitcoin, meaning price divergence is minimal compared to ETH/USD or other volatility pairs. The sophisticated multi-protocol approach is only appropriate for institutions with dedicated DeFi risk management capabilities. Combining lending, liquidity provision, and protocol stacking to optimize yield requires active management of protocol health, incentive changes, and smart contract upgrade risk across multiple protocols simultaneously. For most institutional allocators, the conservative or moderate approaches provide the most appropriate risk-reward trade-off for Bitcoin yield enhancement. Tokenized Bitcoin represents one of the most mature institutional DeFi use cases, combining a well-understood underlying asset with established infrastructure and genuine yield generation from real economic activity. WBTC has demonstrated over 5 years of operational history without custodial failures, providing a meaningful track record relative to most DeFi protocols. The 2024 governance discussions and the emergence of Coinbase's CBBTC demonstrate that the tokenized Bitcoin ecosystem is still evolving and institutional allocators must maintain active monitoring rather than treating WBTC as a static infrastructure component. The institutional approach should include annual custodial risk reassessment, governance monitoring, and evaluation of emerging alternatives as the tokenized Bitcoin landscape develops. For institutions ready to begin deploying Bitcoin in DeFi, the practical starting point is a conservative lending allocation using WBTC or CBBTC in a single established protocol like Aave. This conservative entry point provides institutional familiarity with the operational mechanics, yield generation characteristics, and monitoring requirements before expanding to more complex multi-protocol strategies. The operational learning from a conservative initial allocation is valuable regardless of whether the institution eventually decides to expand its tokenized Bitcoin DeFi program.